The main goals of monetary policy: high employment, economic growth, price stability, interest rate stability, financial market stability, foreign exchange market stability. But how it will work, we'll discuss it. High employment, that is goals because of these two reasons. Because when there is a high unemployment in the economy, so what will be? There is a human misery. People will be suffering from the financial distress, loss of personal self-respect, and that will also increase in crimes also. And when unemployment is high, then what will be? The economy will not be able to get ideal workers and also idle resources, and resulting in lower gross domestic product. But when this unemployment that will be low, so because the frictional unemployment, which involves searches of workers by find suitable matchups, that is also desirable. And because policy can do little about structural unemployment due to mismatch between job requirements and the skill of workers. And the goals of high employment should seek not unemployment is equal to zero, but unemployment must be greater than zero, consistent with full employment at which the demand for labor equals the supply of labor. This level of unemployment is called the natural rate of unemployment. Economic growth. So, the goal of steady economic growth is closely related with the goals of low unemployment, because business are more likely to invest in physical capital to increase productivity and growth when unemployment is low. And if unemployment is high and factories are idle, it does not pay for firms to invest in additional physical capital. So, therefore, policy can be specifically aimed at promoting economic growth by directing and encouraging firms to invest, or by encouraging people to save, which provides more funds for firms to invest. In fact, this is stated purpose for of so-called supply-side economic policies, which provide tax incentives for firms to invest more and for people to save more. So, what will be happening? So, when the economic growth that is continuously increasing, so it will motivate the investors to invest, and it will also motivate the people to make more savings, because they are getting the employment if the economic growth is increasing. Price stability. In the recent years, the policymakers have become increasingly aware of the social and economic costs of inflation, and more concerned with a stable price as goals of economic policy. In fact, price stability is viewed as the most important goal of monetary policy, because inflation creates uncertainty that may hamper growth. Because when inflation will be increasing, so what will be happening? So people, they will not make more demand, and if they are not making more demand, so supply will not be increased or not be increased, making more investment. Inflation makes it hard to plan for the future, because the investor, they have such perception, maybe that if the price is continuously fluctuating and if it will not be stable, so that will hamper the investment of the investors. Inflation may strain a country's social fabric by creating conflicts between different groups, because the gaps between the rich and poor will be increasing, and it will create the conflicts among groups. Extreme inflation, known as hyperinflation, leads to slower growth, for example, in Argentina, Brazil, and Russia in recent past. Interest rate stability, which is a very important goal of monetary policy, is desirable because fluctuations in interest rates can create uncertainty and make it harder for both firms and households to plan for the future. A central bank may also want to reduce upward movements in interest rates, because such movements generate hostility towards central banks and lead to demands that their independence and power should be reduced. So, interest rate stability must be required for the household as well as for firms also. Stability of financial markets. Financial crisis can interfere with the ability of financial markets to channel funds from surplus spending units to deficit spending units, thereby leading to a sharp contraction in economic activity. The promotion of a more stable financial systems in which financial crises are avoided is thus an important goal for a central bank. The stability of financial markets is also fostered by interest stability because fluctuations in interest creates uncertainty for financial firms affecting both their profits as well as their net worth. So therefore financial stability is required in markets. Stability in foreign exchange markets. The value of dollar has become a major consideration for the Bank of Canada. An increase in exchange markets makes Canadian industries less competitive with those abroad, and decrease in exchange markets stimulates inflation in Canada. Also, preventing lars in exchange rates makes it easier for firms and people involved in international trade to plan ahead. Stability extreme movements in exchange markets in financial markets is thus viewed as a worthy goal of monetary policy. In fact, in countries which are even more dependent on foreign trade, stability in foreign exchange markets takes an even greater importance, because if foreign exchange market stability will be there, so imports and exports that can also be balanced, and how much exports can be increased, the people who are or the countries who are depending on specifically on foreign trade, so they can make decisions on it. Conflict among goals. The monetary policy which we have mentioned these goals, so sometimes the monetary policy have conflicts among their own goals also. जो goals हमने mention किए थे, high employment, economic growth, price stability, interest rate stability, financial market stability, foreign exchange market stability. So what will be happening? High employment with economic growth, because the economic growth will be increasing, so that will generate more and more employment opportunities for people, and there will be high employment in the economy. And when interest rate stability will be there, so the financial market stability that will also be there, because the financial market, so they can take decisions, or the investors and the households, investors regarding making investment and household to making their savings. However, the price stability is in conflict with interest stability and low unemployment in the short run, but probably not in the long run. For example, when an economy is expanding and unemployment, both interest may start to increase. If bank tries to prevent an increase in interest, this may cause the economy to overheat and stimulates the investment and the savings. But if the bank increase interest to prevent the stimulates in the short run, unemployment may increase. The conflict among goals may thus prevent central banks with some hard choices. So when the conflicts among the goals of monetary policy are there, so the central bank they make hard decisions ki how the policies that can be maintained, that can be controlled, so that investment in the economy can be boosted, and the people they can be initiated and are motivated to make more savings, so that can be used for further investment. So thank you very much. Please don't forget to like, share with your friends, and